All right. Good evening and welcome everybody to the first quarter Desert Vista Board Education Series. Tonight's education event is all about HOA and condominium insurance. With us this evening are some representatives from CHDB Law, formerly known as Carpenter Hazelwood, for those who are unaware still of the name change, and then the Firebird Agency. We are going to do introductions in a minute, so we'll introduce everybody. But those are our co-hosts and sponsors for this evening. So here we go. Here's our agenda for the evening. We're going to do some introductions. We will go over types of insurance coverages, common claims, handling insurance claims. We're going to discuss why insurance is continuing to go up at the pace it is and ways that communities can improve their insurability and mitigate risk. We'll talk a little bit about avoiding insurance confusion, and then we'll have time for some Q&A. All right, first for introductions. Mark's actually not on with us, but I'll turn it over to Javier. Javier?
Yes, thank you. My name's Javier Delgado. I am a shareholder at CHDB Law. This is my 23rd year of practicing HOA law. We're a team of 40 attorneys. Really excited to be here, share some knowledge with you, and look forward to your questions as well. Back to you, Michael.
Thank you. Travis and James.
Thank you, Michael. Appreciate this opportunity to share more information about what everybody's enjoying in the condominium world, insurance and the rates. But we've been involved with HOAs for over 20 years. The experts on our team have, and we have a lot of knowledge and experience. Although insurance seems to be changing on a daily basis, we try to keep up on it to help you all manage it better. James?
Thank you. I'm James Conaglario. I specialize in HOA insurance. That's the field I come from. I used to be in the HOA management field. I switched over to insurance. So I'm very versed in HOA and also in the insurance field. And thank you for inviting us, Michael.
Absolutely. Thank you guys for being here. I think everybody on the call pretty well knows who I am, but I am Michael LaPointe, one of the owners here at Desert Vista Community Management. I personally have been in the HOA industry for over 20 years in a variety of roles. Our team here at Desert Vista is now 7 strong, and we enjoy serving each and every one of our clients and are glad to have so many board members on this evening. All right. To get us started, we're going to cover types of insurance coverage. I will probably ask Travis and James to chime in a little bit here, but I'm going to primarily handle this portion. We're just going to walk through the various types of coverage just to make sure everybody's on the same understanding of what our coverages are and or could be. To get us started on this screen, we have property and general liability or GL coverage. These two together are commonly known as your master policy or your package policy. And so be aware if we're referring to master policy or package policy, this is what we're talking about, probably these two combined. On the property coverage side of things, the things we think everybody should be aware of and understand, first and foremost, is your property valuation and blanket building limits. We can't tell you how many times, Travis and James probably more so than me, but even just us from the clients we've taken over, how many times we go to look at insurance, renew insurance, what have you, and we discover that the community is underfunded in terms of their property coverage. And that's because they don't have the correct property valuation or building blanket limits listed out. These are usually easy to discover because, quite honestly, if you have a reserve study, you're looking at your reserve study and what it has as values. The insurance carriers do have their own systems for valuing buildings, and it may come in differently. But if you look at your reserve study and it says that your property as a community is worth $20 million and you see that you have coverage for 5, you can guarantee you're underinsured in that aspect. And so why that's important is because it gives grounds for carriers to deny claims. If you have a loss, let's say you have a building that burns down, if you're a condo property, and you have a building that burns down, well, you might have enough coverage to cover that building. But if the carrier goes, oh, you're not properly covering your whole community, you're only covering 20%, we're only therefore going to pay out 20% of your loss because you didn't have full coverage. So it's important that you have proper property valuations and building blanket limits and that you're covering those accordingly. Similarly, it's pretty important to understand replacement cost versus actual cash value. I refuse to put cash value policies in front of our clients. We want replacement cost policies. We want to be sure that in the event of a loss, the insurance carrier is paying out enough to replace whatever was lost today, not what it cost back when you actually built it or when it was built. So those are important things to note there. And in regards to that, more recently, we've started to see what's known as inflation guard. This is probably the first area I'm going to ask Travis and or James to chime in and explain a little bit about what inflation guard is.
Yeah, inflation guard is a way that insurance companies or a policy can be valued to help cover the increasing costs of property, property repairs, materials, anything that goes into the property. And so there's a percentage built into the policy that will allow for an increase through the policy term based on that percentage number. And so depending on when there's a loss and where you are in the term, you could have an increase in valuation of your property based on just how long you've been in the policy and what time frame it is. So it can be very advantageous. A lot of the banks really like it because it does help cover the cost of inflation, and so it is a benefit, and it can be very helpful for many reasons or many options. But yeah, and it's not that it's that much more expensive either. It's one of the few several options we have, but it is good. It is a good option for sure.
Perfect. Thank you. So some about property coverage, just to make sure we're all on the same page. Property coverage is just that. It covers what property you are responsible for insuring, and not necessarily maintaining. There is a difference between maintenance and insurance. We'll talk a little bit about that later. There are things in HOAs that HOAs are responsible for insuring that they don't necessarily maintain, and there are things that HOAs are responsible for maintaining that they don't necessarily insure. We're not going to get into that too much tonight because that could be a class all of its own, but we are going to touch on it. General liability covers the association from liability claims. Our next section is going to talk about claims in particular, so we're not going to get into what claims those could be, but it's really incidents that could happen in your common areas. So somebody gets injured, things of those nature. It's the liability you have. It doesn't cover your property per se, it covers your liability. And there's not a lot to talk about in terms of what you need to be aware of or look for there, but it is important that your liability coverage include hired and non-owned autos. And that covers you, obviously, should somebody drive into something in your community, drive into a building, drive into a wall, drive through your landscape even, into a fence. It doesn't matter. That's the portion that we need to make sure we have to cover automobile accidents, is the hired and non-owned autos. And then the contractual liability too. Keep in mind that a lot of liability for HOAs comes from the governing documents, which are in fact a contract between homeowners and the association. So contractual liability is really what we're looking for out of our general liability. Travis, do you have anything you wanted to add to that?
Yeah, the coverage for hired and non-owned autos also extends to board members or individuals who are acting on behalf of the board. If they are in an auto accident, whether on-site or off-site, and there's a lawsuit that is raised against the association based on that auto accident, a liability loss, that policy will give them up to $1 million typically of liability coverage to fight those lawsuits. So it's a policy that we apply to many different industries, not just condos, but this also provides some liability coverage in case of a lawsuit is brought against the association in relations to an auto accident where a board member or a person acting in the name of the board is involved.
Perfect. Think about it this way, board members. You are driving to a off-site board meeting. Some of you have board meetings that are in person but don't take place at the community because there's not a facility for that. Driving to a board meeting, you get in an accident. Although it might be uncommon, it's not. It certainly occurred in HOAs. So somebody finds out that you were acting in capacity as a board member, and they want to list or name the HOA in a lawsuit or what have you. This is the coverage that provides the association some protection there. Okay. D&O or directors and officers coverage. So I don't want to say that this is the most important coverage, but I do think that from our experience in the industry, the majority of claims we see brought against associations tend to be D&O claims. So we'll talk more about claims in a little bit, but here's what your D&O coverage should cover. It should cover your board of directors, past, present, and future. It should cover your committee members and other volunteers, potentially spouses or significant others of board members, hopefully spouses or significant others of board members. And then your management partner, I don't know of a management company that it is not a contractual requirement that we are listed as additional insured on the D&O policy. It should also include defense costs outside of limits. And these are things a good agent in this industry like Firebird Agency and a good management company like us will look for you. But we want to know that if you have a lawsuit, your defense costs will be covered outside of your policy limits. If the policy is all inclusive and includes the defense costs, and you get a claim that results in a $700,000 payout, you have $1 million claim, and you get a claim that results in a $700,000 payout, but you've also expensed $500,000 on legal fees. Well, you're only getting $1 million of coverage, and so you're out $200,000 out of pocket. You want your policy to cover defense costs outside of your policy limits, so your policy limits cover the actual claim or loss, so to speak. It should also include non-monetary claims. Again, Travis and James probably experience this more often than we do, but there's a reason as a company we don't, unless specifically requested by a board, go look at companies like American Family and Farmers or State Farm, because while they dabble in the HOA industry, they don't specialize in it, and they also don't have standalone D&O policies. And oftentimes things that really are paramount, like non-monetary claims, get left out. One of the biggest things boards get sued over is non-monetary claims. It is you're not enforcing your documents, you're not following your CC&R. So it's not a monetary claim, it's a non-monetary claim, and it's pretty important that be included in your D&O coverage. Breach of contract claims, again, your CC&Rs are a contract, so breach of contract claims should be included in there. Defamation claims, I'm not going to get into too much details about what those are because those are covered in the claims section we're going to get to momentarily. And then the ability to choose your own legal counsel is something we prefer to see in there. Sometimes that's not in policies, and when it's not in policies, the insurance company will appoint the attorney who's going to represent you, who maybe through that insurance agency has HOA experience but is not an HOA attorney. We really like to see your policies give you the ability to choose your legal counsel so you can use an HOA attorney to, protect you, fight for you, all of those good things. All right. Last couple here, crime and fidelity coverage. Crime and fidelity coverage is another area when we take over communities, we often find communities to be underfunded in. The recommended coverage, suggested coverage for crime and fidelity coverage is your entire bank balance plus 3 months worth of assessments. So whatever you're insuring from crime and fidelity should cover everything you have in the bank plus 3 months worth of assessments. And this is your protection for, embezzlement and things of that nature. So this is an important policy and something you want to make sure that you're covering your full cash balance plus your 3 months of assessments as listed there. The umbrella coverage is recommended. A lot of communities don't do it. That is a board decision, but umbrella coverage basically gives you additional protection and extends over your general liability, including the hired and non-owned auto and your D&O policies. So we do always recommend that. We do ask that the insurance brokers put that option in your renewals and let the board decide on that. And the other one is also not a requirement, but I will tell you from our standpoint, it really is. We want you to have workers' comp. Workers' comp covers a number of things. It covers board members. We have board members who will go put the holiday lights out on their gates and that type of stuff, or inspect roofs for hail damage. Board member gets injured doing really anything for the association and wants to make a workers' comp claim. Well, guess what? They can. So you have to have that coverage. Similarly, volunteers, you're doing a community cleanup day, somebody gets injured, that's a workers' comp claim. And then vendor employees. Now, in an ideal world, vendors have their own insurance. We require them to be insured. We require that the association and us be listed as additional insured. But if they let their insurance lapse, it could be days, if not weeks, before we get notice from the carrier that they have let it lapse, and they could be out there doing work and an employee could get injured. When they make a claim for workers' comp, they can make that claim against both the association and the vendor. So it's important that you have workers' comp. I think for every HOA that doesn't actually have employees, workers' comp is still in the $500 range. So it is a very minimal cost for, proper protection for the community. Before we move on to common claims, does Travis or James or Javier have anything to add about these types of insurance coverages? Anything we might have missed that we should have said?
Nothing here, Michael.
Great job, Michael. And if you want to become an agent, let us know.
Thank you. All right, next up is common claims. I'm going to turn things over to Javier with CHDB Law. You'll notice in the image here, one of the other partners there who was going to be with us tonight but couldn't. For those of you who joined late, he had an emergency meeting to attend. But Mark Saul is one of the foremost experts on insurance claims and has actually written the manual for Arizona, which is what you kind of see a snippet of the cover for here. So CHDB, Javier, and Mark in particular, very well versed in handling insurance claims and everything you need to know about those. So Javier, I'm going to go ahead and turn it over to you, sir.
Well, thank you. First of all, Mark really regrets he wasn't able to attend tonight, so he does wish everyone the best. When we're talking about insurance, Michael, the thing that I am constantly hearing from my boards is, why is it so expensive? Because it is for everybody, right? And so I think, the thing to understand there is, it's there's a lot happening out there. And so let's talk for a moment about why it is getting so much more expensive for everyone. And Michael, how do I advance to the next slide? Well, thank you. Okay. All right.
I'll handle that for you, sir. Sorry.
Perfect. I appreciate that. Thank you. Okay. Awesome. Yeah. So the first thing is, there have been all these wildfires out in California, right? We all know about that. And that has had a big effect on the market. There's also been a lot of claims, in the other Sunbelt states. And, what we've seen is this huge shift in the market where, people are moving to Sunbelt states. We've got changes to the climate. It's just drier, I'm not looking to get political about anything. But there are a lot of fires. And so when we see things like that, those are great examples of property claims. And so, when I talk about insurance, it has the potential to be a sort of dry subject compared to maybe some other things that are a little bit juicier. But I will tell you, folks, I was just telling Michael before today's seminar started that I am actually dealing with my insurance company right now because I experienced a house leak. Like, I woke up yesterday morning and I had 3 inches of water in the washroom. And so I'm going to be dealing with my insurance company. James, Travis, don't worry. It's USAA. So, it's not going to be in the loss record over there. But it's tough. It's tough when you have these claims. So having a water loss, great example of a property claim. For those of you who lived in the valley about 10 years ago when we had that like mini cyclone, it wiped out, like it literally just reduced an entire community in the Levine area to a third world country. There was mud flowing through people's homes. These are examples of storm damage. And then, of course, we have communities in northern Arizona who are constantly concerned about forest fires, smoke damage, that sort of a thing. So when you have these types of claims, what is the most important thing to do? We'll talk about how to handle a claim, later on. But what you really need to know is, hey, we've got to look and see, is this something that is the association's responsibility? And the big question that comes up is, well, when we encounter these things, what's the association's role? Because you're all board members, right? And you all know that you're protected. You've phenomenal protections under the Arizona Nonprofit Act. That law says, as long as you follow the duties of a board member, a good board member, meaning that you're making decisions in the association's best interest and you believe them to be the association's best interest, and you're not doing nutty things like stealing money from the association, you're going to be okay. But it also says you've got to follow best practices, and that involves the duty to mitigate. So I've got this example here on the screen. In fact, I have a community that's actually dealing with a sinkhole in the middle of their parking lot, and they're having to address that. And so they're having to cordon it off and take proactive steps to get it fixed. So any questions out there about
We
property
actually
claims so
have
far?
a community with a sinkhole in it right now too, Javier.
Oh, wow.
Yeah,
Oh,
one of
Mikey,
our
go ahead.
condo communities has a sinkhole. We almost swallowed up a Gilbert trash truck. So
Oh, wow.
we're dealing with that.
Yeah.
And, we're several months in and people are already getting agitated about the time frame, but it's not an easy fix, as you
No.
know, and takes a lot of engineering and time and money. It's an expensive project, to say the least.
Yeah, being in the HOA field is definitely a multidisciplinary thing, but it never a dull moment. So any of you out there that are retired and you're thinking, hey, I'm thinking about a second career, talk to Michael. I'm sure he could use some additional community managers. All right, let's go to the next slide then, Michael. Let's do that. So general liability claims. I put this article up here about the BIA tax because I think at least, this is really unfortunate, at least twice a year in the office, we are dealing with bee attacks. And the way they normally play out is, you've got a landscaper who's just, minding their own business. They're mowing the lawn, all of a sudden, bzzz, and they get stung multiple times. And it's always the same thing. A swarm of bees migrated, they're hiding in one of the valve boxes, they get disturbed by the machine, and they get stung. And in fact, sometimes, these poor guys and gals, they died because some people have, a sensitivity to bees. And so these are, serious claims. And when these types of things happen, you have a right to be concerned. What's the association's role? Are we liable? Do we have insurance? And these are real concerns that associations have. Another example are slip and falls. What if the sidewalk isn't being, properly maintained? What if you've got more than a certain amount of distance between one portion of the sidewalk versus another, and somebody has a slip and fall? Well, that could be a claim. That's why you have insurance. Of course, you want to maintain the things you have. And also dog bites, big source of claims right now. Everybody loves Fido. I love gardening, but we have a dog too. And he's a lot of work. So when you have any of these types of things, if something can go wrong, it will go wrong, especially in the HOA world. But that's why you have insurance. And that's why we have to figure out, hey, what's the association's role? And if we have any potential liability in here, well, then let's hope that we have insurance to safeguard the association. So you absolutely should have, property insurance as well as GL, or general liability insurance, as we refer to it in the HOA vernacular. Next slide, please.
Yeah, Javier, can you address real quick, why do defamation and breach of contract show up under both GL and D&O coverage, which is where we're going next.
Yeah, I was talking with Mark about this, and what he wanted me to pass along was if we had a Venn diagram, those like overlapping circles. It's just one of those weird things where you can have these claims, under even the D&O as well, and it's just one of those things where it's something that's going to be covered under the association's policies, and really it could depend on who's saying what. Like if, for instance, the board, a board member or board representative says something that someone alleges to be defamatory, well, that might fall under the D&O. If there's actual damage that results, it could fall under one of the other claims. So there is the potential for overlapping coverage. And so I'm not an insurance professional. I don't sell policies. I'm not the right person to talk about, hey, does this policy adequately cover us based on what the documents say? That's where, James and Travis come in to play. But I can certainly tell you, you should have insurance. You want to talk to the right people, make sure you've got the right coverage. But even in my experience, I know that there's a potential for overlapping coverage. And so one of the tidbits, and Michael and the rest of the team here will talk to you more about it, is if you have a claim, I think it is important to consider tendering it to all of your carriers, because you never know when you have overlapping coverage, and you want to make sure you're taking advantage of those things. So thanks for that question, Michael. Talking a little bit more specifically about D&O claims, if I had to pick, and James and Travis may have a different experience because they see the claims, that come in, but I would say that, D&O claims are probably one of the biggest claims that we deal with, at least in our office, when we're defending lawsuits. And it's just basically the allegation is, board, you made a bad decision, and it caused some type of claim. And so we're going to go after you because the association made a bad decision. Or when I say a bad decision, maybe it's just a decision that people got upset about, like the architectural approval was bad. Or the association says, hey, I think someone's, defaming me, or I think that, there's a breach of contract. So all sorts of examples here. Anything else to add about that, Michael?
No, I think the big things to note, boards, is just that, non-monetary claims, the injunctive relief suits, those represent the majority of suits against a board of directors. And this is some information from Firebird, but that's the majority of claims against the board. And then more specifically, the most common suit against boards is discrimination, which can include selective enforcement. You're not enforcing everything equally and fairly. So those are the most common claims against boards. As you can see down here, breach of contract, which is simply not following your CC&Rs, is the third most common. But this is really, D&O is really the area where the majority of claims that happen occur. All right, let's move on.
All right, and fidelity. So unfortunately, we have had some examples in the Phoenix and surrounding areas where rogue actors have unfortunately done things that they shouldn't have, and they have stolen monies. I want to emphasize, this is a case that had nothing at all to do with Desert Vista. Or with Michael. This is a completely unrelated case, but again, in 23 years you're going to see these things. One of the more interesting things are when these types of frauds are alleged, you actually work with the Secret Service, because they're the department, federal department, that investigates those types of claims. And you're really at risk if you're not being represented by a professional managing agent, because it just, unfortunately, we represent churches as well. Happens so many times with religious institutions. There's just a lot of, faith in the fact that the people you're working with are doing the right thing. Sometimes, unfortunately, there's bad actors. Sometimes it happens in the HOA world, and that's why you want to report those to law enforcement. And I'm confident that Desert Vista has policies to cover them in case they were so the unimaginable is ever to occur, which we don't think it ever would.
Yeah, and I want to chime in here. So boards, we occasionally get from prospective clients questions about, don't you have crime coverage to cover us? The answer to that is no. Our crime coverage covers us if we have money stolen or embezzled. It cannot and will not cover you. That is your coverage, and that is why it is important that you have proper fidelity and crime coverage. Now, I'm confident, that our team is never going to embezzle or steal money from you, but it is important that you have it and you have the right levels. We have a community who faced embezzlement at the end of the 90s, early 2000s, to the tune of almost $200,000. And still to this day, it's kind of an uphill battle to recover from that. So it's something you never want to face. Having the right coverage to protect yourself is incredibly important. Theoretically, if you were embezzled from your management team, can you make a claim against them? Yeah, potentially on the liability side of things, but their crime policy is not covering you. That's not what their crime policy does. It's a potential liability claim. But oftentimes when embezzlement happens, at least in my experience, and I've seen or heard of cases out here and out in Colorado, it's almost unheard of that money gets recovered because that money ends up being spent. The person might get found and they might be in jail, but it's unlikely you're gonna recover any money or all of your money. That money is spent by those persons, in my experience. So recovering the money is difficult to say the least. The incident in the late 90s, early 2000s that one of our communities was part of, yes, claims were lodged against that management company's insurance, and claims were paid out, but they embezzled so much money that not everybody got paid out, or not everybody got paid out what they were owed. So you just have to protect yourselves and make sure you have the right limits for those things.
All right. Well, that takes a great transition to, well, what if but you do have a claim? So let's talk about how that gets handled. So the first thing you want to do is got to know what your policy is, and sometimes we have the question that comes up. Well, what's the association's responsibility to insure? Sometimes you might have too much insurance. Sometimes you might have too little insurance. You might not think having too much insurance is a problem, but actually it can be a problem, because if like in my instance, if I live in a condo and I have a water leak, and it's something that the association's not required to insure, but for whatever reason your coverage does extend to like the units and water losses caused by owners due to their negligence or just accidents or whatever within the units, well, guess what? That's now another claim that you're paying out. So you want to make sure that you talk to people like James and Travis to make sure that you've got the right kind of coverage. Sometimes there's a notice requirement. I know that there are a lot of concerns by board members. Is this something that we should talk to the insurance carrier about? I'm always going to tell you the most conservative answer, which is I think you should put your carrier at a minimum on notice. And James and Travis can answer this better than I can, but in my experience, at least, putting a carrier on notice of a potential claim is not necessarily the same thing as a claim, and in theory should not cause your coverage, your premiums to rise.
Real quick,
But
Javier, before you move on,
yes,
I'm going to
yes.
ask James and Travis to chime in here, because in my experience, at least in the last few years, it didn't used to be. You could put them on notice and say, hey, we might have a claim here. This happened. We're not sure if it's going to be a claim yet. But in my experience in the last couple of years, in particular, when we've notified an insurance agent that, do you want to open a claim? Because that's the only real thing we can do here to put us on notice. If you open a claim and you don't pay out, it's still a claim against you. So Travis, James, your thoughts on that?
Yeah, great question, great talk, subject. I'm seeing more and more carriers that take in notice of a claim to put them on notice as starting a claim. There's no difference between a notice and an actual claim. And so when you let them know, hey, this may happen. Especially this really happens in the case of D&O, when there's a form of threat of suit, or someone saying, I'm going to sue you, or hey, that's my brother's an attorney, whatever. And that's when they say, hey, someone said this. Okay, let's give them notification that there could be a lawsuit. However, more and more frequently, the carriers or the insurance companies are just taking those as claims and filing a claim and just waiting to see what happens. I don't know if it's a legal issue or what they're doing, but several carriers that we work with do that. So I don't know if
Can
it's
I
necessarily
just chat, Travis?
Yeah,
I
go
don't
ahead,
mean to. The one thing you want to do is you say put them on notice. I think one of the things that Michael understands is, and dealing with us, is you can call us and call the insurance agent, us. You don't have to call the carrier. You can call us and say, okay, this is the situation. We may have a claim. And if we can look at the policy and see, what's covered, what's not covered. It could be property, could be anything that comes up. So you don't have to call the carrier and say, hey, I may have a claim. Call us. We can kind of give you direction based on the policy and your CC&Rs and your documents to give you some guidance, and then see if the claim does come up. And we can handle that for you in these type of things. So you don't have to call the carrier and, as Travis said, them put in it as a notice and then put in it as a claim. And then, like as Michael stated, the insurance rates go up.
Yeah, and I skipped one slide over, Javier. I'll move back in just a
No
second.
worries, we're fine.
Because
We're
this
fine,
is
yeah.
actually on this slide. But the other thing to note is, I'm usually less concerned about this with those D&O things. The threat is a threat until they actually do something. But I see this more and more with property claims, where a board is like, we gotta put the insurance company on notice. I'm like, well, let's hold off, because we don't know if this is going to exceed the deductible, and with deductibles ever growing, it's not going to make any sense to file a claim if it doesn't exceed the deductible. So, or it's a delicate balance of when do we reach out to insurance versus when we don't. I mean, usually we're getting a mitigation company out there, getting bids for repair before we go, oh yeah, we should reach out to insurance on this, or no, this doesn't reach the deductible or barely reaches the deductible, it's not worth it type of deal. So that's where we see it a lot these days, I think.
And Michael, what would you say is the average deductible now? It depends, right?
So more and more, it does depend, but I do think that on the property side of things, more and more 10,000 is kind of your normal. I think for condos, it's getting pushed up to 25,000. But also we're seeing more and more a separation of general claims versus water claims. So water, I mean, we have communities who, particularly condos, who saw their regular deductible double from 5,000 to 10,000, or 10,000 to 25,000, and then their water loss deductible double from 25,000 to 50,000. Basically because the insurers are saying, we don't want to insure your water losses anymore. And that's essentially what's happening there. And James and Travis will talk a little bit more about, all of those things happening here in just a moment. But yeah, I think it's more common for it to be 10 to 25,000 for your standard deductible now.
Yeah, and really the reason we're talking about, the notification issue is because if you don't tell the carrier and you wait too long, frankly, you may be effectively self-insuring. And that's really our concern is, we just want to make sure that if you've got insurance and if you want to take advantage of it, you're following whatever timeline the carrier has in place for you. And again, that's something that the insurance guys can talk to you about. But really, my advice for you is just make sure you document it. Think about, like, if you get in a car accident, what do? You take pictures, you make a police report, you document it. If you have any other types of claims like a slip and fall, you're going to do the same thing, right? You're going to take photos, you're going to document it, you're going to have some witness information because stuff gets lost in translation, and so that's the key there. make sure you document. And I think we talked about the rest. If a lawsuit's been filed, that's when we would say, okay. And sometimes, frankly, there's very little or no notice. A lawsuit's filed against you. At that point, we are absolutely going to do a stop, drop, roll, pick up the phone, and let the carrier know, right away, because there are timelines in Arizona. Typically it's a 20-day response time. In many cases, to file a response to a lawsuit. If you don't do that, the clock starts to run. You can actually have a default judgment entered, and a lot of times when we get involved, we try to keep things, really low key. We try to get an extension if possible from the other side, just to say, hey, they're tendering to insurance. Can we get a professional courtesy of an extension, just to figure out who's going to even defend them? And, most attorneys who are reasonable, even a lot of the owner's attorneys, they're like, yeah, they get it. And they'll usually grant those extensions. So make sure you keep everybody involved. Next slide, please. All right. Well, it looks like it's back to you and the team, Michael.
Yes, sorry. I said that's it for you for now. I am going to go ahead and turn it over to Travis and James to talk about increasing rates and improving insurability and mitigating risk. So, gentlemen, I'll leave it to you.
Thank you, Michael and Javier. Thank you for that information. It's been very enjoyable hearing two non-insurance people talking favorable about insurance. I appreciate that. It's been a good time. Insurance, I get it. We get it. It's not fun, and it's a challenge, and it's frustrating. And that's part of our job here at the Firebird Agency, to help you as a board get through that. Michael is a really good resource. He's very knowledgeable, has some great experience in it. And our team as well can assist and walk through that process. So yeah, why are rates going up so much? I'm going to go through these pretty quick because, again, we're getting close to the end here. But it's really kind of, as Javier talked at the beginning, it's everything you're seeing on the news. All the big wildfires, the hurricanes, the hailstorms, the floods, everything. Anytime you have a large catastrophic event, there is a lot of habitational or home destruction. And so that just rolls up the line, and those big costs. And that just affects every insurance carrier and every company. And so we are all impacted by that. And even though we live in Arizona, in a wonderful place with very few storms, we still are impacted because the companies that insure us insure our friends and neighbors in the other states that have the same problem or have those problems.
Travis, before you touch on the next three,
yeah,
can you segue into, because I really think this applies to natural disasters, but how we're seeing carriers get out of the industry and why that's part of why rates are going up as well?
For sure. A lot of this is, I don't know if anybody's seen this or not, but California is a great example where laws change and things make it hard for carriers to recoup costs, and big losses make them just say, we can't survive in the state of California. The costs and losses are too big. We're not able to recoup our costs, and so we need to move out. And so that's happening very frequently, as Michael said, in the condo and HOA world, because insurance companies do take on a lot of HOAs and condos, a lot of risk. And then when they experience loss, the losses are very big and extensive. And so they end up losing too much money, and they have to cut their losses and just move out of the industry. And there's other reasons for that too on the other sides we'll talk about, but it is a trickle-down effect. Big losses just push rates up, push companies out. And what happens is you have less options as a condominium association to insure. There are options, and that's what we're here for, to provide multiple options. But it does get hard when you have these big disasters and your options are limited due to big losses that force companies out. As it says here, some other big things that you have a little more. Well, you don't have much control of the age of your community. Unfortunately, it is what it is. When your community, your buildings were built, is not going to change, but you can take care of them so that they remain in good shape. As it says here, roofs are a big deal when it comes to qualifying for insurance and for good rates. is how often and when, and when recently when roofs were replaced. Maintenance, that is the number one area where users association you have the most control in the impact on your insurance, the maintenance of your association. A well-maintained, managed, clean, taken care of association will more times than not get the best rates, have the most options, and will still stay insured. And so that's, if I could say anything, that is number one point or requirement is just make sure you follow your maintenance plans and stay away from the deferred maintenance.
Yeah, Travis, I'm going to chime in there real quick.
Yeah.
So deferred maintenance and lack of proper reserve funding kind of go hand in hand. We are seeing carriers want to see reserve studies so they understand where you're at these days. But what I can tell you on the deferred maintenance side of things is I don't think any of our condos that have renewed insurance in the last year have done so without an insurance loss adjuster coming out to do an inspection after renewal. I haven't really seen it with the single family home HOAs, even those with, a fair amount of amenities as much. They happen periodically, but they want to make sure they're putting physical eyes on your properties now too, and making sure things are maintained. And when they do that, they provide lists of here's the things that you have to do, or else we're going to drop you. And so, they're going to require things to be maintained, or that you show that you have a plan in place. Here's our plan for this. We have an engineer working on it. We have a phase schedule. We're doing this, whatever the case is, they want to know that things are being addressed. So those two things go hand in hand and are growing in importance in the insurance world. And so I just wanted to chime in on that. I'll turn it back over to you now.
Great point, Michael. Yeah, it's a guarantee. If you change insurance carriers at renewal, you'll have an inspection within 30 days after your renewal. They will want to check out your association for sure. Okay, again, if we can keep your association well maintained, that is greatly going to help us. The other thing is keeping your losses and your claims to a minimum. We talk about deductible amounts. That's the primary reason why we go higher in deductibles. $25,000 deductible seems crazy, but it really makes sense if you want to manage the amount of claims your association has. And we're talking, in this case, we're talking property claims and GL claims. These claims, when you have a property claim or a GL claim, even one will, most of the time, I'd say 90% of the time, will non-renew. Your current insurance company will non-renew you at renewal. And with that claim, it bumps you to another level, a whole nother group of potential or options. There's a whole group of standard carriers that won't even consider quoting it with just one claim. And then pack in your age. It's a double, triple whammy. So what we can do to keep the claims down, well-maintained association and high deductible, those are two key areas. There's some things that are just out of control. We get it, but those are two key areas. And the nice thing about the deductible, again, it depends on how your CCRs are written and how you assess those. But if you do have a high deductible, the key would be then if there is a water leak or damage in a unit and your deductible is $25,000, then you can and if it's less than the cost is less than $25,000, then that will go on to the unit owner's insurance, their HO6 policy. And that's key to this whole process of keeping deductibles high and claims down, is ensuring that each unit owner has their own coverage. Not only that they have coverage, but they have coverage that will satisfy the deductible of the association's coverage or policy, and any other assessments, any other costs that they have. HO6 policies are relatively inexpensive comparatively, especially to the association's policy, and that's a key to ensuring higher deductibles and making sure the association is covered. Okay, we go next. We talked about this pretty well. Now, we did say, this does say 1980 here, and I was going to let you know, Michael, it's actually 1990 now. Just in the last year and a half, more than half of the standard insurance companies that we work with move their requirements to 1990 or newer, and there's actually one that's 1992, which means if your association was built prior to 1990 or 1992, they won't offer insurance to you. And so that limits where you are just by the age. Fortunately, there are insurance companies out there that do offer it. But one thing to understand in this is because when we've taken the age of the building in factor, and if it's before 1990, then it takes your number of insurance companies from here to here, and every other association in that same age bracket is going to the same insurance companies. They get very busy, very bogged down, and it takes time to receive renewal quotes or competitive quotes. In some cases, it can take up to 2 months to get a quote because they are so busy with all the older associations. But
Can
that,
you quickly just
unfortunately,
touch
is where
on
we are.
the difference between standard and non-standard carriers?
Yeah, good point. Standard would be your Liberty Mutuals, your State Farm, your the companies that advertise in the Super Bowl, the companies that are well known and are out there. They offer their standard carrier, and the primary difference between the standard and non-standard would be they are registered in the state that they operate in, and that allows, in case of if the insurance company were to go insolvent for any reason, the Department of Insurance of that state, say in the state of Arizona, would then step in and honor the insurance policy that you had with that company until you're able to find another policy to replace it. So that's a standard carrier. They are admitted in the state. They have protection with the state insurance agency, and they offer the best rates and the most coverage. A non-standard is just the opposite. They can work in any state. They can provide insurance in any state. And most of the companies are good rated companies, well-backed, well-funded, great customer service, great claims experience. However, they aren't admitted in the state, meaning they don't have the backing of the state, of the Department of Insurance for that state. But it's because they offer less insurance, less coverages at a higher rate. And they offer insurance to the higher risk opportunities. For example, like construction. One of the highest risks out there. A lot of non-standard companies insure construction companies. Did that make sense, Michael? I explained that.
It did, yeah, absolutely.
Yeah.
I just wanted to end this slide by saying that every time we do renewals for any community who has responsibility for roofs, we are asked, when is the last time roofs were replaced? And so some of our communities are in the process of phased roof plans, and we can present them the Excel spreadsheet we've put together showing which buildings have been replaced already and which ones are still due, and that all helps. Or all the roofs were done 5 years ago. Great, here's the warranties, here's the invoices, fantastic. All of that helps. So if your roof gets to a point, I don't even know, maybe you can tell me, Travis, but I would say 20 years old and you can't show that you've replaced it or have plans to replace it soon, it really starts to weigh on the insurance carrier and what your rates are ultimately going to look like. So
yeah, 20 years would be the magical number for roofs. Sooner is better, but yeah, 20 years or less. I think we've discussed this. I think this is good. Follow it. And if you haven't done one in a while, please do it. It will help. There's some areas in the country where insurance companies won't even write insurance unless there is a current reserve study within the last 5 years. Arizona's not there yet, but we could get there within the next year or two. I know California and some places in the Midwest and South, you've got to have a reserve study within the last 2 years at earliest, and 5 the most, or insurance company won't even provide insurance. So very important to have that. If you haven't done it recently.
That's part of the reason why we have reserve study policies with all of our communities and try to make sure they're updated every 3 years. So it's not just best practice from a funding and maintenance standpoint. It's important on the insurance side of things as well. All right, this takes us to our last section, which will be brief, and then we'll do some trivia questions and then have some Q&A for anybody who has questions. But Javier, do you want to take over again and talk a little bit about avoiding insurance confusion?
Yeah, please do. Next slide, please. So The biggest thing that we're talking about right now is you've heard so much great information tonight. Okay, how do I synthesize this? How do I make this work for myself as a board member and for my owners? Because, in life, the best thing to do is keep it simple. Well, I've got a tip for you. My pro tip is consider a maintenance and insurance matrix. And I hear that insurance people love this because it helps everyone to understand, who's responsible for what. And I've got an example, on the next slide. And this is just, they all look, kind of different, but it's really could be this simple. What's the component? And these apply, to condos. It can even come into play like into a planned community, especially if it's like a townhome setting. But what's the component? How do we define it? How is it defined under the governing documents? What's the association responsible for? What's the owner responsible for? And we're looking at keywords like who's responsible for maintaining, repairing, replacing, and also insuring. And at what point does that responsibility get shifted back from the association to the owner so that everyone knows, hey, if I mess up, if I do something, if I don't know, go to Europe all summer and I don't bother to turn my water off in my condo, could that be something considered negligence that might shift a certain amount of responsibility to me? Yeah, it might. And so that's why we think that these make sense. And we also think that it makes sense to adopt a insurance deductible resolution. Deductibles, something you've heard about today. I was asking Michael how much they are. They vary, you heard, but they can be quite a bit. And if you do have a loss, if you do have a way to allocate that back to an owner because they did something or didn't do something they were supposed to, this can help clarify that confusion. So just some pro tips for everyone today. Back to you, Michael.
Yeah, absolutely. I'm just going to chime in on that. We like to see all of our condos get these. I think most of our condos currently have these. I don't know that a lot of our single family home communities or otherwise PUDs have them, but they're great regardless. I will say that law firms, HOA law firms offer a lot of HOA law firms offer maintenance matrices, but very few dive into insurance as well. CHDB does a great job with their matrix, and encourage you to have one. The insurance deductible resolution is really just a document that typically clarifies your CCNRs and easily spells out that what deductible and why a homeowner is responsible for a deductible. We only have one condo community in which their CCNRs are terribly written, and the deductible has to be a common expense. So the only way they can get around that, which they probably will never successfully do, is to amend their CCNRs. Travis, there is a question in the chat. If you could try to answer that in the chat, I think that might be a good question for you. While you're looking at that, this does take us to the end of our time, so we do have some trivia questions, and I am going to give everybody the ability to unmute yourselves. Not that you have to, but we are going to ask for either in the chat. Actually, I think the best thing to do would be to ensure that it's fair for everybody. There is a raise your hand feature. If you don't know where this is, you can find it under the reactions on the bottom. There's a button titled raise your hand. So when I ask these questions, I will be looking to see who raises their hand first. I will be asking them to unmute themselves, and then we will go from there. Our first question of the evening is, sorry, just a second. Okay, our first question of the evening is, what is the recommended crime or fidelity coverage limit that you should have as an HOA? All right, we got a hand up. Let's see. That is Melissa. Melissa, please go ahead and unmute yourself. Melissa? Melissa, are you with us? You raised your hand. Can you put your answer in the chat if you can't unmute yourself? Okay, what do we got in the chat? Yeah, Sunil, right now the mute button is still locked for everybody, but I gave Melissa the ability to unmute herself back. So
Okay, I lost you there.
Oh.
Sorry. Sorry about that. I don't know if I just totally lost you guys. I was going to answer the bank balance and then 3 months of assessments, I think is the question you were asking
that
for.
is correct. You are going to get a $50 gift card, courtesy of Firebird Insurance Agency for answering
All
that
right, thank you.
correctly. So thank you.
You're welcome.
Our second question of the evening is, what type of lawsuit represents the majority of lawsuits against a board? Anybody know this one? Ah, Melissa again. Melissa, you're gonna make a killing tonight, apparently. Let's see. Oh, we have two hands up. Well, the other one's Anne, who's a member of our team, so I'm not going to let her answer that. But Melissa, what is the answer on this one?
Was that the DNO?
It is in DNO, but can you be a little more specific?
I'm not sure what the specific, the directors, well, it's directors and officers. No, I don't know. I'm not sure what you're looking for.
Okay, I might give it to you if nobody else has an answer. Right now, I don't have any other hands.
Okay.
So does anybody have an answer? Use the raise your hand button if you do. Please don't be shy. Okay, well, James has his hand up, which is interesting. James, you can't answer either. All right, Melissa.
No, I know. I was just joking. To have a little fun.
Oh, Sunil, give me just a second here. All right.
So
Sunil?
yeah, no, but I think it's the injuries that happened from people working on your property.
Okay, so the answer we were looking for is the non-monetary claims. So all the things boards get sued over that aren't for any value, you're not following your documents, you're discriminating. It's the non-monetary claims are the number one thing boards get sued over, which is a big part of your DNO. What I'm going to do, Melissa, is I'll go ahead and, because we actually have 4 gift cards and only 3 questions, I'll go ahead and give you this one. I'm probably going to make 1 gift card a random drawing. But I do have one more question that hopefully somebody else can answer. So my next question for everybody is, let me just lower the hands that are up real quick. Okay. From a building component standpoint, the age of which component can most significantly impact insurability? All right, I have a hand up from Gordy was the first one. And if Gordy doesn't get it, we'll go on to April. But Gordy, please go ahead and unmute yourself.
I would say it would be the roof.
That is correct, sir. So you're going to get a $50 gift card courtesy of CHDB Law. The fourth $50 gift card is courtesy of us here. I will put everybody's names into a randomizer online and randomly draw an attendee from this evening to see who wins that one. With that said, I'm going to unlock microphones. You don't have to unmute yourself right now, but I did unlock microphones. And I'm going to ask that if you have any questions, you're free to put them in the chat. You're also free to go ahead and just unmute yourself and ask your question, but we are at the Q&A portion of the evening. So any questions?
Hey, Michael,
I
I
think
can
Greg
answer
had a
that question in the chat
Oh,
real
sure.
quick. I have to say this is new to me. This is a new one. And I don't know how often this would come up, but an immigration claim defense cost sublimit of $100,000 protects you from any claim brought against the board based on immigration defense. It has come to like if you're questioning an employee whether they are a legal citizen or not, and then they want to sue you because of that offense or what you're saying. And so it has to do with lawsuits based on immigration claims. And I don't know how often that would come up, but I guess if you had a member of the board or maybe a volunteer, someone worked for the association that you said, well, you can't be on the board because you're not a legal citizen, and then they decided to sue you because of that, then that's what this would cover.
Yeah,
Kind of
and
a
it's
left field
pretty
one, but-
unique. I've seen it come in a couple of times in the last year. I don't think I've ever seen it in a policy until the last year, to be honest with you. So it's not. It doesn't seem to be something that has caused anybody's rates to go up. It's just something that has been added by some carriers. So it is what it is, I suppose. But that's the best explanation I've gotten for it as well. Anything else? Any other questions from anybody? If not, I really appreciate you. Oh, yes.
Michael.
Yes, Pauline.
Sorry, this is Pauline. Yep, I have a quick question. I know you guys had said something about like dogs, out fighting and things like that. What about livestock that get out and injure someone? Who's responsible for that? So if a livestock actually leaves their property and is out in the streets and everyone's trying to help out and someone gets kicked or bit or whatever.
Let me set the stage for you guys. This Pauline is the president of an equestrian community where people have horses, cows, mules, pigs, chickens. So they have all the things associated with that. And every now and then, somebody's animal gets out. I think chickens more than anything. But the HOA has very little, almost no common area. So I guess the question might be, I guess what I would want to know actually is, who would the HOA have any insurance responsibility, or do you think they would, if this happened in the public road or on somebody else's lot, versus what about if it happened in one of our very little common area spaces?
So from an insurance
This is Javier.
standpoint,
Yeah, go ahead, guys. Yeah.
yeah, I want to hear what you say too, Javier. From an insurance standpoint, it's all going to come down to the common question, the common statement, covered cause of loss. If that type of action is actually something that's covered in the policy, then the policy will respond. But it also comes down to the situation, what happened, who owns the livestock, who's responsible for it, and what their policy says. So there's a couple missing factors that we need to know to see who's going to respond. But the biggest thing is it a covered cause of loss? I mean, it could be GL, right? It could be general liability based on the situation and ownership and what the association is responsible for. So it certainly could be a general liability claim.
Yeah, and just to kind of piggyback on that, when you mentioned livestock, we actually have a community in the valley that borders in a Native American community, and there's some ranchers there that actually maintain cattle, and the cattle have been getting loose, but it turns out there's some specific state laws that deal with liability associated with cattle. But dealing with horses, and if you've got an equestrian community, I can envision a situation where, if the horses are being maintained, like, for instance, on an association maintained stable, and if like the doors or obviously I'm not a horse guy, but if the doors to the stables fail, and if they're supposed to be maintained by the association, I could see, someone making a negligence claim. If there's like a rule that says the horses are supposed to be maintained in a safe manner on the streets under someone's supervision, and that's not happening, I could see someone bringing, like a breach of contract or also negligence claim. So, yeah, I mean, I think, look, bad things happen, people lawyer up, and, that's why it's always good to have insurance and lawyers and great management. So, great question.
We also have a question in the chat related to this specifically. Is there a statute of limitation on claims regarding, well, really anything, but some of the specifics listed here were dog bites, falls, etc. So maybe both from an insurance standpoint, Travis, and then Javier from a legal standpoint, are there any statutes of limitation that come into play?
Great question. From an insurance standpoint, it's going to depend on how the policy is written. If it's a claims-based policy, then the claim has to come within the policy term. So if there's a year-long policy, you have to file that claim within that year. That's a claims-based policy. If it is a occurrence-based policy, then you can file a claim whenever, whether within that term or outside that policy term, as long as the claim occurred during the policy term and it was covered under that policy. Of course, occurrence-based policies are better. It gives you more opportunity to file those claims, and those are more frequently what we offer. But that's the determining factor is based on how the policy is written, whether it's a claims-based or occurrence-based.
Yeah, so in Arizona, generally speaking, it's a 2-year statute of limitations to bring a personal injury claim. But if the claim is brought under some other theory, like some type of breach of contract action or some type of failure to enforce, and you're able to prove damages, in a different way, it could be a 4-year. Possibly even a 6-year statute of limitations. So really just depends on the exact nature of the claim. But if we're talking about just straight PI personal injury claim, generally speaking, 2 years.
Perfect. Thank you guys very much. Anything else, board members? No? All right. Well, Gordy and Melissa and whoever gets randomly drawn, we will work to get you your gift cards, and we thank you all so much for joining us this evening. We hope you found this useful and enlightening, and we really do appreciate your time.
Thank you, Michael, for inviting us.
Thank you, Mike.
Thanks to all the presenters.
Guys, as I mentioned, this is recorded, and I am going to go ahead and end the recording, but the contact information for both the attorneys and the Firebird Agency are on the screen and will be part of this. We'll make this available to you separately as well. I will send out a PDF of this presentation to everybody who attended this evening. So thank you guys very much. Javier, Travis, and James, thank you guys very much for your time. We greatly appreciate you as well. Thank you all so much.
Thanks, Michael.
Thank you. Have a great night.